we are today. We're doing another interview on our Minorum Gold YouTube channel. We're interviewing several analysts and journalists. And today we actually have the portfolio manager, or Mr. Jonathan Wellum, the CEO of RockLinc Investment Partners based in Burlington, Ontario. It's a private investment firm. Actually, I'll just introduce you, John. You can introduce your firm yourself and tell us a little bit about us.
Sure. Thank you very much, Sonny. I'm pleased to speak with you. Yes, our firm, RockLinc Investment Partners, and more information, they can just rocklink.com, and that's linked with a C. We formed the company almost 5 years ago, beginning of 2010, and I've been in the financial business for about 24 years now. Started back in 1990 in the mutual fund business, and enjoyed that immensely up until about 2009. Sold that company to Manulife largely, and then wanted to continue investing money more for private clients rather than sort of the broader retail market through mutual funds. So we set up RockLinc, and we run segregated accounts, separately managed portfolios, so individual stocks and bonds and preferreds, and create personalized, customized portfolios for individuals. And largely, I'd say that would be middle to higher net worth in individuals, but it varies. A lot of good people that I know, friends and individuals who are looking for very high quality portfolio management, differentiated, where we can add value and do that cost effectively. Interesting.
I guess that just to add on that, the topic of today, what I wanted to talk to you about was bond yields, interest rates, and gold. And you've done extensive segments on your RockLinc YouTube channel. It's called Debt Storm, and I'll provide a link to our audience here to view that. I thought that was one of the best presentations I've seen on the ongoing debt problem globally. And you spoke about the that we face, and we hear about, and we know that, for example, the tenure Canada bond is down 2.32%. Trailing 10 years, it's down from 5%. The 5-year Canada bonds are down to 1.5% from the, which is 0.5% below the inflation rate. U.S. Treasuries are down at an 11-month low of 2.4%. The U.S. economy contracted for the first time in 3 years, and not to mention, last but not least, Spanish yields are at a 200-year low. Based on your presentation middle of last year, what do you foresee for the debt storm going forward? Have things changed? Are things getting better, worse?
Well, when we look at the numbers, and I think that the most important thing from an investment perspective is stick to the facts and analyze them, based upon fundamental analysis. So we look at the bigger picture and we say, okay, the debt. And when we're talking debt, you can look at that sort of on two levels: the personal debt within countries, and then the debt level that we were a little bit more preoccupied with, and that is the debt that the countries are carrying, or the sovereign debt of countries. And if you go back to really the early part of this century, so you're back to 2000, 2001, from that point up to about 2007, we had a substantial marking up of debt. In fact, if you really were to go back to the original point, really in the late 60s, early 70s, a lot of the nations started spending a lot more money than they should. They went off the gold standard, and so we've seen debt going up as a percentage of the country's production GDP for really 40 years. But if you go back to, say, 2000, just to make it more relevant and closer in time, the debt really started to escalate. So if you looked at all of the debt out there, it might have been about $80 trillion 12, 13 years ago. Now it's over $225 trillion if you add it up around the world. And if you think about 2008, where much of this sort of, we really hit the wall, if you will, because of the debt and the way that we were financing homes, and the way we were securitizing a lot of this debt and packaging it up into instruments that were inappropriately priced and so on. We ran into serious problems. If you go back to that point and then you look forward to today, all we've done is continue to add to debt. The governments have taken on more debt The debt level has continued to increase as a percentage of GDP. It has not gone down. And in many countries, not every country, but in many countries, personal indebtedness as a percentage of their income has gone up. This is particularly the case in Canada. In the States, it's come off a little bit. So overall, the indebtedness of our nations, the Western world, if you will, Canada, United States, Europe, Japan, and even in China, in order to keep things moving forward, there was the assuming of a lot more debt. So actually, debt levels have continued to go up. And interestingly enough, the only way this has been controlled and seemingly sort of put to the back burner, and so people have become somewhat, I think, complacent about the whole debt, is that the central banks in all of these various countries, Canada, United States, the UK, Europe, Japan, China, have all been printing money to provide liquidity to keep the game going. And part of this printing of money is they buy a lot of the bonds, so they've been able to push the price of the cost of these bonds down. So interest rates have gone down, bond prices have gone up, and it's hidden the fact that we continue to add to the debt, and this debt crisis is actually getting larger, not smaller. And in putting off the day of reckoning, I think we're actually setting ourselves up for greater problems in the near term. And we just can't. This is not sustainable. You can't continue to print money, keep interest rates really low, and continue to add debt. At some point, you've got to pay this debt down. You can't continue to add to it.
So what are the consequences then? Why continue to print all this money knowingly, assuming that they knowingly know that, this is creating, future problems?
Well, I think I'd answer that question on two levels. First of all, I do believe that in many cases that's all they know. Mm-hmm. That, in other words, if you have a framework or a worldview or a monetary view that believes that the central banks are there just to, control interest rates, and all that they can really do is move interest rates and print money, and that's what you can do, then that's what you're going to do. And so that's what they see. If you're a barber, every head that you see looks like it needs a haircut. And so I think to a certain degree, the central bankers are bound by their own structure. They aren't looking outside of it. And so I think that would be one way to look at it. The other way to look at it is that, look, if you really were honest about the situation and you put your hand up and you said, I think we need to actually start balancing budgets, shrink the credit out there, you're going to have to bring on an economic downturn that would be fairly severe. Now, I think that economic downturn is going to come regardless, but do you want to bring it on or do you want to push it into the future? And so human nature generally will opt for pushing something into the future rather than dealing with it decisively now. We just had an election. We're just talking a day after the election in Ontario. Good example. Did Ontarians really want to hear a true message about the debt problem, or do they want to push it into the future and re-elect a government that has created the problems here in Ontario for quite some time? The answer, push it into the future. So if you're a politician and you are in some of these key positions, I think it's a combination of that's all you know, that's your worldview, that's the way you look at monetary policy, number one, and number two, who really wants to bring on the problems, if you will. Push them off, put them into the future, let some other person worry about them.
Interesting. I guess we have to learn the hard way.
Yes.
Well, interestingly how you mentioned that, it's a significant debt problem right now, especially with Canada. We've talked about the lower bond yields and interest rate lows. There was actually a recent report by Equifax Canada stating that Canadians are in, across Canada, a total of $1.4 trillion in debt. Now, their report was that, they have adequate income to service these debt levels, quote-unquote, monthly payments are being made. However, they're forecasting an annual increase in installment loans by 11%, credit card installments as well by 5.9%, and just on June 6th, the CMHC is no longer insuring financing of multi-unit condo developments, given the fact that the market across Canada, the housing market that is getting a little bit too hot to handle. And the Bank of Canada, the governor actually, Mr. Pelosi actually came out and said, high house prices and high household debt there's vulnerability for a sharp correction in housing. Is this, just like you said, it's not sustainable? So is this debt sustainable, or what do we do about it?
Yes, and just a couple of days ago, Moody's downgraded a number of our banks, and the reason for that downgrade was tied to their mortgage portfolios and the indebtedness of the individuals they've loaned money to. So back up a second. Look, when you look at the Canadian debt-to-income levels, we're well over 170% plus. To put that in perspective, that used to be about 40% debt-to-income back in 1970. So we have tripled, we've almost quadrupled our debt-to-income ratios over the last 40-plus years.
Mm-hmm.
Now, you can get away with that for a little while, and you can sort of push those limits up. You have two incomes is more prevalent than it was in the past. You've got interest rates substantially lower, but you can only push that so much, and we are really on the outer edge now. In the United States, it didn't even get anywhere near where we're at before they got into trouble, and their debt levels, debt to income in the United States is actually quite a bit lower. It's about 25-30% lower, or percentage points lower. So it'd say 140% debt to income. So the reality is we cannot continue this. That Canadians have too much debt. Incomes are not growing fast enough to buy and to pay for the increasing prices of homes. And so stretching and stretching and stretching can only go so far. The other issue you have is that you're quite right. Overall economies are not growing very quickly. And the reason they're not growing very quickly, I mean, there's probably a couple of reasons, but certainly top of the list would be consumers already have so much debt. They just can't continue to go out and just consume. So the rate of consumption is slowing. If the rate of consumption slows, the GDP slows. If the GDP slows, then you're going to have eventually that's going to translate into a topping of housing prices. And if housing prices start to come down and people have borrowed, against those houses, it's going to be an issue of their, affordability and running into negative equity potentially. The other thing is we have aging populations. And so you have this big issue that we are aging quickly. Even with immigration, we're still aging quickly, and so people should be paying off debt as they get older, and they're not able to do that. So for the first time in Canadian history, we have seniors and retirees with mortgages and, credit card debt and, leasing cars and paying for them. So this is a sea change, and so we've jammed debt everywhere, and again, as you've pointed out, no, this is not sustainable. If we get an uptick in rates, or there is let's look at it this way. Either we get an uptick in rates because of inflation, and you have to ultimately price that into your interest rate structure. That'll put so many people offside. Or if we don't get an uptick in rates, it'll be because of deflation. That is also very brutal. That means the prices of homes and assets fall. That means banks get into trouble. And that means also that people go offside and go into negative equity. So either way, we've stretched this thing as far as you can go. And so that's why, investors need to be really careful. People buying homes and investing need to be very prudent and again, not be stretching themselves and making sure they maintain a strong financial position, and they're buying assets that will maintain long-term value and purchasing power.
Well, I guess we'll find out later in the year. I mean, right now Canada is just keeping the bank rate at 1%, the overnight rate there, and I guess the next statement is from the Bank of Canada will be around August, I believe, for an update in terms of their outlook. But so far, they're forecasting 2015 growth of 2.5%. Just to go on a side note here, you mentioned a very important point of income levels not catching up. Why do you think that is then?
Well, I mean, a couple of things. The income of Canadians has not kept up with inflation, and I'm not just talking about buying computers, but you're really talking about especially asset inflation, homes, right, in particular. And I think there's a couple of reasons. Number one, globalization, that many jobs have been outsourced around the world, and there's been the influx over the last 20 years of cheaper labor. That's put a cap on our ability to really, charge more, if you will, for labor. And so this whole globalization has put pressure on labor costs. It's brought some prices down for some goods, but it's really held labor down. Number two, I think the government just getting larger and larger in the economy and the printing of money. We just aren't as productive as we need to be, and so we've lost a certain degree of productivity internally in our own countries. Our own cost structures are not as effective, and so we just can't pay the kind of labor costs. But I think most importantly, we really lost in many cases, especially in Ontario, manufacturing jobs, high-paying jobs that have either been automated through robots, or we've offshored a lot of the jobs. And we think we're wealthier because we've been able to bring in cheaper goods, but if we're not making them and we're not investing back in our own people and into higher paying jobs, it's a real problem. So incomes have not kept pace with the inflation of homes. So when I think of the price of a home and the incomes that were made even 20 years ago, they were much, much more affordable than they are at this point. And so young folks that are looking at buying a home now, they need these low rates to even possibly, to fund the prices of homes. And but the problem with that is that they're so leveraged, they're so stretched that they just live month in and month out just to pay a mortgage, and that's not healthy. And that puts a lot of stresses on families, on homes, and it's, again, not going to be sustainable, especially if rates were to go up just a little bit.
And that's very interesting points. I mean, we've now covered the areas of what the debt storm is, the consequences. Is it sustainable? Obviously, it's not. So what can we do to really protect ourselves? I mean, you said that this current state of the economy in your previous segment on RockLinc on your YouTube channel, that the economy, its best description right now is fiction, just because of the massive money printing. And it's not only the U.S. It's the Bank of Japan, Bank of England, the Fed, Bank of Canada, People's Bank of China is even doing a lot of printing as well. And you're seeing even the recent announcement by the ECB, the European Central Bank, decreasing their lending rate to 0.15% from 0.25%, and their deposit rate has now gone down to negative 0.1%. And they have even mentioned that there are further measures that are still needed to start the economy there. I mean, it's still sluggish. So, some people like Charlie Munger of Berkshire Hathaway, have opinions that gold is kind of a relic. But what is your take on gold? Is it what it is supposed to be? A kind of a hedge against the U.S. dollar, or is it some kind of protective measure itself?
Yes, I mean, a couple of things. Number one, just before I specifically answer that question, when you look at the policy of all of the major central banks around the world, and they all say, the economies are moving forward and we're 5 years into a growth cycle and so on, and yet they can't increase interest rates from historically, century low values. It tells you that we have a serious, sick global economy. And if it doesn't tell you that, I think you're just not looking at the facts. And also, when you add the printing of money, that's done for two purposes: to buy up bonds so that you can lower the interest rates on the sovereign debt, and it's also done in many cases to weaken currency. So there's a bit of a currency war going on. Even Europe is, once their euro exchange rate sort of hits 1.4 to the dollar, they're in trouble because they can't compete. So then they start to suggest they'll do some quantitative easing or printing of money. So they got to get their currency down. So this tells us that there's a bit of a currency war going on around the world, and also that rates can't be lifted even though there's inflation, because the economies cannot take an increase in interest rates. And this is the way you try to cheapen debt, by keeping your interest rates below inflation. So that's that issue. Now, in terms of gold, I'm a value investor, so I really enjoy Warren Buffett and Charlie Munger and so on. I have a great deal of respect for them. But when it comes to gold, to me, gold is money and it's currency. and it has staying power and long-term purchasing power. And that's proven over thousands of years. It's not just, something that we've got to suggest, the last 20 years, 30 years, 40 years. This is thousands of years. And so when I think of gold, I think that gold has a place, particularly at points in history when you're getting to the end of a monetary system or a system that needs to be restructured, that the system itself has become over-levered or corrupt, and you're going to ultimately have to restructure your money. So at different epochs or times, gold to me becomes a wonderful hedge, a protection against paper assets, assets that are, debt-based, and that debt is going to either be reneged, people aren't going to pay it, or it's going to be inflated away. And the way you're going to protect yourself, I believe, is then to have precious metals, and gold and silver would be certainly two of the most important ones. So when I think of gold, I think of, if things were really going well and the governments had surpluses and we had great, honest politicians and the world wasn't printing money and interest rates were a proper reflection of risk and rewarding investors long term, who would ever want to own gold? But we don't have any of that. And so that's when I come back and I say, look, for 8 up to 15% or so of one's portfolio, I would want to have exposure to precious metals. And the way we do that in our firm is we have some investments directly in bullion, and of course we make sure if we do that, it's through companies. We use some of the Sprott bullion funds because they don't have any paper contracts. The bullion is sitting at the mint in Ottawa. We also own a couple of miners, and for us, we're not geologists, so the miners that we look at are sort of mid-tier, really well-run, profitable, long-term reserves, low-cost producers. And then we also have some of the royalty companies, so the companies that finance mining operations for silver and gold. And so we try to go across those three different levels. And for us, we think that is essential. I mean, absolutely essential at this point, given the monetary stress that we have. The other things that we do is we make sure a good portion of our clients' assets are in other hard assets or tangible assets, things like infrastructure or water assets or agriculture. So buy scarce assets, productive parts of the economy, so that if the money system is restructured, which again usually happens every 40 years or so anyway, this shouldn't surprise us. But if it's restructured, then ultimately you'll own assets that will become valuable in the new world, the new monetary system. And so that's the way we approach it. We want to be approximately right rather than precisely wrong, and we don't want to be naive about this and stick our heads in the sand and pretend this isn't going to happen. It's inevitable. We don't know the timing, but the current course that we're on, the debt, the derivatives, the aging population, the unfunded liabilities, all of these promises that governments have made that aren't even in our debt numbers, they're just too large to sustain. And so, investors really need to be prepared for this and to make sure that they are impacted as little as possible, although all of us are going to be impacted, but we want to be able to come through on the other side in strong form.
And it's very interesting to say that, there's a good portion to be devoted to precious metals investments. I mean, with all that's going on all around and all the aforementioned points that you discussed, the other interview that I did actually with Jane Bhandari and Mr. Bagashtash from Singapore. I mean, we were talking about Singapore itself being a trading hub and several firms setting up there for Singapore to be the ultimate trading hub in the world. I mean, hence why it's called the Singapore Freeport, where all the gold is stored, and the government is making their mandate to become a trading hub. You're seeing several firms set up there, such as Metallar Technologies. Alka Amit, which is a logistics company, has a 200-ton silver capacity vault there as well. For all the points that you mentioned, you're seeing a lot of these initiatives by these several companies that are kind of playing to what is going around the world. I guess this will lead to my next point, is that many banks based in Asia are increasing their holdings on gold as well. but Germany, Austria are looking to repatriate their gold, albeit very, very slowly.
Well, I think you are getting a remonetization of the financial system in many areas using gold and silver, no question. And I think, again, for North American investors, this really is quite foreign to most of us, not unless you're an immigrant from Europe or the Far East. But we've had relatively stable systems. We've had governments that we could largely, when you think of governments, trust. And we haven't had this kind of indebtedness apart from war, but then government was much smaller at that point. We didn't have governments at 45, 50% of the economy and then totally in debt and then making all of these promises. So for a lot of North Americans, they think, well, I just, do I really need gold or silver? Do I need this as a hedge? But history tells you absolutely, with all of the factors that we've talked about, that you talk about with many of your people you interview, these are historical situations that are quite unique to North America and to North American investors. And but when you go to Europe and they've seen the ups and downs and hyperinflation, or you go to the Far East and your currencies, or South America and your currencies are collapsing every once in a while, or India, where they, if you had bought an ounce of gold back in the 70s, boy, you'd be quite wealthy. If you owned your gold, or if you owned a rupee, you'd be, basically bankrupt. These are stark differences. We haven't seen that in North America, but we're going to see some difficulties. And that's when I think North Americans have to look outside of our own country, outside of our own narrow economic views and Keynesian philosophy that's taught in our universities, and go back to basics and really look at the world more objectively. And then all of a sudden, all of these things are going to become much more relevant and important. And I can tell you, the last 6 years, I've certainly altered, some of my views as I've had to, really think through what's going on and look at the bigger picture and how am I going to best serve my clients. And it's not by sticking my head in the sand and just sort of trusting all of these central bankers. It's like saying, wow, this is out of control, and they really don't know how to get out of this. And so we ultimately have to think outside the box and protect ourselves.
And, it's very interesting that you mentioned the India gold, because some trade numbers that came out, Mr. Koos Jansen, who runs In Gold We Trust, and I'll reference the article here, but he mentions that the March official gold, the gross gold import accounted for 60 metric tons, which is up 88% from 32 tons in February. So we are seeing, the import restrictions are still in place. I mean, the new government, I haven't seen an update yet in terms of them repealing those restrictions, but we'll see in the next few months once they implement some of their initiatives there. I mean, and another point is that, for example, the Shanghai Gold Exchange chairman has also mentioned that, they want to internationalize their gold exchange. And you're seeing this all across the board. It's a very interesting dynamic in relation to what you're recommending to for your clients and your audience, that a specific portion should be reserved for gold investment. And one question I want to ask you is that like Germany and Austria, they're looking to repatriate their gold. You're seeing increased gold demand. Why is a country like Canada? Why is there no gold in Canada?
The only way I can answer that is ideology, just absolute blindness on the parts of the individuals who would control those decisions, that they're just blinded by their own, very narrow monetary and economic elitist views that are completely out of touch with reality. It's unbelievable that a country like Canada would sell off all of its gold and believe that, fiat currency that you just tell people is worth something based upon the debt of the country itself, is going to be money. And I don't think there's any other real honest answer, but just a completely naive group of people have made that decision. That is a poor decision. The other thing I just mentioned too, that sort of ties into some of the points you're talking about. Two more points. Number one,
sure.
The U.S. dollar. That has been the reserve currency, and as many people have pointed out, certainly nothing new in what I'm going to say about this, but there are many countries around the world who are very concerned about the staying power of the U.S. dollar. For economic reasons, the U.S. is weakened. It's a nation that's stretched itself immensely and has massive unfunded liabilities. And also other countries, there's political issues, and if they can get one up on the states, they would love to do that. So in terms of the U.S. dollar remaining the central currency, or as important as it has been the last 30 years, there's no way that's going to continue. So its relevance is continuing to go down slowly, but it's continuing to go down. And as that continues to go down, people want to protect themselves against that change of reserve status, and gold certainly, or silver, especially gold, becomes one of the best alternatives. And then the second item, which again factors into this, and certainly my concern in making sure anything that we own in the gold and silver space is backed by real gold and real silver, whether it's companies that have the reserves or whether it's the royalty companies that have a monetary stream coming from the mining companies, or whether it's the bullion itself. The hypothecation or the lending out of the physical gold many, many times over. As we all know, gold has been lent out. And when the problems emerge in a serious way, there'll be a lot of people who think they own gold and think they have a good position in it who don't own the gold. So you've got to make sure, anyone listening to this or investors, that you actually have true unencumbered physical exposure to the actual bullion itself. We're seeing the problems in China with copper and with other base metals that have been used as collateral, and we all know, everybody knows, gold has been leased out many, many times over. Some people say, it could be 50 to 100 times over for every ounce. And when the problems emerge, you want to make sure you own the real stuff, and we've certainly tried to do that to the best of our ability with our clients.
So, I guess the closing question here is that what do you foresee over the next couple of years from this unsustainable debt situation? I mean, what do you think governments will continue to do? Do you think they'll just keep on printing and then or will they kind of realize, okay, let's restrict it, let's kind of reduce the QE?
Good question. And I think it can go one of two ways, and I think the weighting or the probability will be to trying to inflate the situation, which would be keep rates low and continue to print money, add money to the system. So I think that's the greatest temptation for governments, because it appears on the surface that that's going to be the less painful and you can get away with that. Now, you won't get away with it, but I think that you can stretch this game out. So either we do that and go into an inflation situation that is more pronounced than what we already see, and that could get into maybe some hyperinflation. You could get into 8-10% plus rates of return in terms of inflation. We saw that back, and I remember that in the late 70s. I was in high school at the time, and we were running 8, 10, 12% inflation, and so we've done that before.
Wow.
And so that's the temptation. That's what government does almost 95% of the time, if not 100% of the time. They try to inflate the debt away. Or if they did get religion and they all of a sudden decided that this isn't going to work, and they started to rein things in, we're going to have deflation, and that means prices drop, and that means banks go out of business, and that means there's a restructuring of the economy on the downside. Either way, as far as we're concerned, it doesn't matter if it's deflation or inflation. You must own things that have staying power, that aren't going to get wiped out in value, and have proper capital structure, so they don't have too much indebtedness against them. And so we think it doesn't really change the way we invest, but it will change the sort of the look of how things develop. So when you think of precious metals, I mean, gold will maintain purchasing power. That's all that matters. You ultimately have to say, if I have $1,000 worth of gold, it's going to buy me a similar amount in the future as it can today. But if I own something that is a house and drops half in value, that's not going to have the same purchasing power. or some other certainly paper asset that gets wiped out, you can go from being able to buy something today with it to being able to buy nothing with it. So we don't know how it's all going to materialize, but we have to get the debt down. We cannot continue to have this much debt in the society. We cannot run interest rates at zero and negative. We have to reward savings. We have to have a capitalist system that puts a proper cost on money, so there's discipline to capital allocation, and we evaluate long-term projects based upon true rates of return based upon risk. And until we get back to that, we're not going to have a growing economy. Much of what we've seen, Sonny, as you know, in the corporate sector, if you look at the corporations, how are they growing? They're not growing top line very much.
That's correct.
They are growing bottom line, but they're doing that through stock repurchases. So they're shrinking their share float. How are they doing that? Well, some of it's through cash flow, but if you're doing that through your cash flow, you're not investing in the future as much as you could. If you're also doing it through leveraging up the balance sheet, so a lot of them are borrowing at low cost, interest rates, at low cost money, and then buying back stock. So corporations, they look like they're all, these profitable machines and they're growing, but they're not growing top line, they're growing bottom line by leveraging the balance sheet and not investing in the future. And so we look at that as an economy. We go, this is not a good picture long term. We're not going to create the jobs. We're just doing window dressing in order to keep share prices up, to make a few people happy and CEOs get their, their bonus and their options and so forth crystallized. But we're not creating long-term sustainable wealth by long-term investing and having a proper capital structure in place. And the biggest issue is all these low interest rates, the government's just continuing to spend money, governments continue to go further into debt, and the worst person to give money to manage and to run for you are the governments.
Absolutely. Well, just to end off there, I really appreciate your time and gauging your opinions and your outlook on the market, and it's interesting to kind of dig deeper in terms of Canada and what's going on here as well. If you do require any more information or want to get in touch with Jonathan, please feel free to reach out to him. I will be providing the contact information on our YouTube channel in the description and a link to their website. So it's RockLinc.com, so RockLinc.com, and Jonathan will be more than happy to get in touch with you. That's correct, right?
That's right, absolutely. And although I'm a realist, I'm still an optimist. There's opportunities there. In fact, this year we've done very well in many of our portfolios, and I think that look, if you have the right businesses and you're not buying fluff businesses or the latest hype out of Wall Street, and you're buying real businesses that are meeting real long-term demands for individuals, those businesses will continue to do well, and they'll survive ups and downs, especially if they're backed by great balance sheets and super managements.
That's great, John. Thank you so much for your time, and we look forward to the next interview here.
Great. Thank you so much, Sonny. Bye now.
Bye-bye.